Hi everyone! The first trading week of the new year has passed rather quickly. It was relatively calm as markets were gradually reopening after the long holidays. However, there were some positive shifts in the stock market. All three stock indices were trading in the green territory during the week, showing explosive growth on Friday. Wall Street notched its biggest one-day gain this year. The sentiment improved markedly after the publication of the non-farm payrolls report. It indicated a contraction in average hourly wages and the services PMI index. It renewed hopes for smaller rate hikes. The Dow rose by 2.1% on Friday, while the S&P 500 jumped by 2.2%. The NASDAQ gained 2.5%. Hence, all three indices ended the week with an increase. The number of people employed in the non-agricultural sector slightly exceeded the forecasts. Wages grew at a slower pace than anticipated. The ISM data also showed that activity in the services sector dwindled at the fastest pace since April 2020. This week, the inflation report is in the limelight. Apart from that, Jerome Powell will deliver a speech, and the University of Michigan Consumer Sentiment Index is on top. As seen, there will be lots of crucial events that could set new trends. Watch our video review till the end and find out more curious details. Leave your comments down below. Let's start. Although trading at the start of the year could be a bit like a wrestle, speculators do not have much time to sit and think about various scenarios. A batch of crucial reports is due in the first half of January. Even the last week turned out to be rich in events. This is why January might be a busy month. Perhaps it could trigger certain changes. For instance, stocks advanced significantly last week and kicked off the new one on a positive note. Besides, investors are betting on a policy reversal by the Fed. However, the December meeting minutes published last week contained lots of hawkish statements. It seems policymakers remain adamant when it comes to monetary tightening. They believe it's important to raise rates and keep them at a restrictive level until there are clear signs of a slowdown in inflation. Notably, traders are now focusing mainly on fresh macro stats rather than last year's statements of Fed members. After studying new reports, they have come to the conclusion that the odds of a policy reversal are high. Inflation is projected to cool. If so, recession fears will finally subside. If this assumption is correct, the central bank is likely to undertake a smaller rate hike in February. Perhaps there will be more such rate increases throughout the year. Therefore, the inflation report is extremely important for investors. Analysts believe that in December the figures slowed to 6.5%. This data will provide markets with clues about the Fed's rate decision at the next meeting scheduled for February 1st. Currently, about 77% of analysts expect a 25 basis point rate increase. Importantly, optimism on Wall Street was also fueled by the news from China. The country is fully reopening after a prolonged lockdown. Besides, the world's second largest economy has announced an increase in financial assistance to households and companies to support economic growth. It's gradually moving away from the strict quarantine restrictions. The Dow Jones gained 1.4% in the first week of the year. Such a result is quite positive. Judging by the market sentiment, the index is likely to expand its winning streak. However, its recovery may end if inflation data is downbeat. The S&P 500 index rose by 1.4% last week. It's trading in the wide range of 3,800 to 4,500 at the start of the year. Despite the rebound and a good start in January, it's expected to remain in the bear's claws. Stocks are unlikely to hit bottom until traders have fully priced in the recession scenario. A quick V-shaped recovery also looks unlikely. the situation is contradictory, with the prospects of monetary policy and inflation in the coming years are quite vague. Perhaps this is why traders are so optimistic after each rebound in the index. However, it never lasts long, and it is always followed by a sharp decline. Whenever the price reaches the upper channel, the rally stops abruptly. The S&P 500 index has broken out of the bearish channel, but the downtrend prevails. Bulls took advantage of the recent increase in risk appetite following the December NFP figures. The report made investors believe again that the Fed could abandon monetary tightening and start cutting rates by the end of the year. It's hard to predict how long optimism will last, taking into account volatility and market uncertainty. One should remember that no matter what investors are betting on, Fed policymakers remain strongly committed to raising rates until inflation runs steadily at the 2% level. If CPI data reveals that inflation is high and the economy is resilient, this will be a solid reason for the Fed to carry on with aggressive tightening. Speculators are likely to stop factoring in the scenario of monetary easing. The NASDAQ 100 index recovered at a slower pace, climbing by less than 1%. The tech sector is still facing bearish pressure. Shares of such leading tech companies as Apple, Microsoft, and a number of others logged the worst performance last week, adding only 0.08%. Despite the fact that Wall Street extended gains at the start of the new week, market participants are cautious. There are no strong drivers to end the downtrend. Nevertheless, last Friday's rally was a good sign. The main thing is not to lose all those gains and momentum. If so, tech stocks are sure to advance. In this case, the NASDAQ may grow significantly. The index is projected to recoup its 33% drop last year. Perhaps it has already started to do so. On Monday, Bed Bath & Beyond stock was in the spotlight. It jumped in the pre-market trading by 20% amid the sharp fluctuations. However, the company is preparing to file for bankruptcy within a few weeks. Although traders should pay great attention to macro stats this week, another important event is about to unfold: the earnings season for the fourth quarter of 2022. These factors are likely to impact market sentiment considerably. Last week, stocks of commodity companies were the biggest gainers. They climbed against the background of a slight weakening of the US dollar and an increase in prices for precious and some industrial metals by 4%. Shares of cyclical companies were also in high demand. They rose by an average of 3.7%. In addition, before the start of the earnings season, investors had bought stocks of the largest banks. As a result, shares of other companies belonging to the financial sector jumped as well. Top U.S. banks will unveil their revenue results for this Friday. Investors are likely to get rid of shares of those banks whose reports will signal slowing growth and weak revenue forecasts given the current market conditions. It seems that the likelihood of any steady growth is rather low. Market uncertainty persists. Investors are looking for profitable shares ahead of the earnings season. That is all for now. Thanks for watching. Stay tuned to keep abreast of the latest market news. See you.